Hello, welcome everybody to another episode of Arthur's Roundtable. Super grateful for everybody who's paying attention and listening and sharing. So thank you for that. And we're super happy to have Amanda with us today. Amanda was referred in by a friend. And so while we don't know each other, we're going to right now. So for doing this, welcome. Let's start at the beginning of your story, and then we'll get into the business that you're in. That's okay.
I'm in Chicagoland and born and raised here to Lake Forest College. And both my parents were teachers growing up. And I knew that I loved math, but I also, watching them work so hard, I knew that I didn't want to be a teacher. And so my world was heading in the direction of an actuarial science degree. And the way that I thought I was going to get into that was to work for a local insurance agent. And then I was going to work my way to home office, get into their actuarial internship program. Honestly, I got stuck on this side of the business because I love working with people. And so where I am now, I work for a company called BCU Risk Advisors. We do property and casualty insurance for high net worth individuals and single family offices. And we are just solely focused really on providing the best service we can for them. So that's what I do in my day to day.
Is it equally personal lines and commercial?
That's a great question. In the private client space, I would say this is the weird intersection between that commercial lines and personal lines. And even more so when you get into the family office space. Our business is probably 70, 80% personal lines. As our clients, as their net worth goes up, right, that top echelon of our clients, I would say it ends up being about 50%. Just because they do have operating businesses or they have these single family offices that are acting like an operating business for the family. And so we end up being about 50 there.
And I'm probably going to get the terms wrong, Amanda, but there's a difference between working for an independent brokerage, let's just call it that, and working for an insurance company.
Correct.
And I'm imagining you're sitting at that.
Yes.
There's a little bit of delay. I apologize for it. Go ahead.
All good. So I would say the one thing that I like to tell people is there's two kind of like terms in our world, and there's a lot of different ways to define them. The brokerage world, the independent brokerage, and then the exclusive agent. An exclusive agent being somebody who's working directly for one insurance company, and that's typically the only company that they can sell. Those are going to be companies that you've heard of on, all of the channels as it relates to marketing. You know their jingles, and typically the insurance agents can only work for those insurance companies. And then the independent brokerage side, we are true fiduciaries working on behalf of our clients. And so we aren't in a place where we have to recommend one insurance company because that's who we're beholden to. We actually have about 70 insurance carriers that we represent, and we get to kind of matchmake with our clients and put them with the best carrier, with the best coverage, the best pricing. And it allows us to negotiate and provide a little bit of leverage. And so our true goal is to provide service to our clients and get them in the right place with the right risk management techniques, insurance or not.
And the obvious benefit of that is not all insurance companies are good at all risk, right?
That is exactly right. Even you're in the private client space, right? And you're saying, the replacement cost of a home is $1 million, all the way up to $20 million and beyond. There are different carriers along that spectrum that are better fits for others. And then you look at a commercial risk, like a manufacturing company typically has a different insurance company and certainly a different insurance contract than a financial institution because they're just operating differently. They need different coverages, and each carrier typically, is going to focus in a subset of risks that they prefer, they feel like they can underwrite well, and their actuaries have dug in on.
So good for you for exiting the actuarial mindset. It's a lot more fun to be in the front lines with the sales, isn't it?
It absolutely is. But I still take all of that math background with me. Everything from talking to clients about why are we choosing this deductible over another, and then I pull them through this equation, and then I have to apologize, right? Sorry, you got more than you wanted. All the way up to, what does a self-insurance philosophy look like, or a shared risk, philosophy look like? Maybe we're taking on some of that versus insuring the entire risk, whether it be a home or a business itself. And how do we make all of that work?
So there was a time, Amanda, and I'm not picking on any particular insurance carrier, although it's been my experience that the carrier of choice for high net worth people on a property coverage was Chubb, property liability, that sort of thing. Is that still the case?
Yeah, I think Chubb does a great job. They're certainly one of the carriers that we work with. But as the industry kind of grows and consumers learn what's happening, there's branding and all of that, there's certainly been competitors that come into the space. So, outside of Chubb, we've got AIG. They have rebranded. They're now doing an MGA so they can work with additional carriers, and now they're Private Client Select. They do a great job. We have a company called Vault. They're the newest entrant into the market. They're a reciprocal company. Berkeley One, who was started by Chubb executives when Ace purchased Chubb. And, we had some of this just really experienced leadership saying, we're not done with this. And what do we do next? And so they're a Berkeley company. We've got Pure, which is also a reciprocal company. And then we've got Cincinnati. And Cincinnati's been around for a long time, since the 50s, and has had a really good contract in place for their clients, typically in that middle market space. And so they saw, again, the opportunity. Now, to your point, Chubb has the brand. Everybody knows Chubb wants to pay claims. They do a great job. They come and just write you a check, and you're back to where you needed to be. And so all of these carriers that have been slowly following them into the marketplace know the standard that they have to live up to, but they don't quite have the branding yet. And so they're, of course, in this place where they're saying, we need to make sure that we're trying to exceed what Chubb is doing because we're trying to build that branding as well. And so what we found is that competition coming in not only gives clients more opportunity, but it's making Chubb better too, which is everything that you can ask for in our world, as it relates to, just making sure that our clients are getting the best.
Yeah, competition's good, right? I mean, everybody's trying to achieve a standard to not only, it's not just about price. It's like if something goes wrong, you want to make sure they're not just the balance sheet, but their process is not going to be onerous, right?
Definitely.
So what is it that, if you don't mind going down this road for a second, insurance companies are notoriously slow at stuff. For example, adopting technology and AI and all their legacy systems and all that kind of stuff. Have you seen some of the incumbents adopt things that are innovative and more efficient, or is it more the new entrants because they're not burdened by a lot of the legacy systems, be more innovative in using technology and that sort of thing?
It's definitely a combination. So our carriers, they're in this space where they're definitely trying to use big data. Actuaries want this information so that they can better underwrite, so that policies can be approved quicker, or claims can be approved quicker or denied quicker, right? If ultimately that's the decision. To your point, I think what we see is the newer entrants coming into the market, learning from what clients want of the Chubbs of the world, the AIGs of the world that they're not getting, and they're putting that in place immediately. And so then, of course, those legacy companies have to catch up, right? And they have to start responding to that. And we're seeing that, but it's certainly a slow roll. But that also goes with coverages. There's small nuanced coverages that are slowly entering the market. If I'm thinking about a homeowner's policy, something like service line coverage, this has been in the middle market space for a long time. The State Farms of the world, all states, they've offered this for a number of years, and our carriers are slowly catching up to this. The problem with things like that is that they have to get approved by the state insurance departments. So while in Illinois, it's really easy to get something passed. Texas, it's really easy to get something passed. You move to other states like California or New York, there's a ton of regulation that they have to go through, even to not even increase rates, just to add something into their contract to get that approved. And so, it is a slow roll for sure, but, I think what we're seeing is it's definitely moving faster than it was 17 years ago when I started in the business and all of our screens were black and green and we were using, those old school systems. Things are much more user-friendly for us, but then also what's more important for the client.
Yeah, I know just a little bit about this, but not everybody understands that the insurance contract is regulated by each state. So in order for it to be offered in a particular state, you have to have it approved in that state. So the regulatory burden is pretty rough, as you suggest.
Yeah. And I think that's one of the things that, you see these crises that have been happening in California, in Florida, in Texas, some in New York. And this, again, just it all ties into technology. The insurance companies now can map the risks that they're insuring. And so in 2019, 2020, AIG started doing that and realized their concentration was too great. And that if another wildfire ripped through, they would be in big trouble. And so that was, as a result of that, that was when they started non-renewing, and kind of everybody else started following suit because they realized, okay, so AIG's overconcentrated there. And if we start to take on all that risk, which looks today to be really good risk, but if a wildfire is heading that way, maybe it's not. All of that technology pulled in really helped everybody kind of determine what's happening. Now, problem is there were some carriers who didn't didn't use that technology to say, okay, well, we shouldn't take this risk because we insure 5 other homes on this block. And so they've gotten themselves into trouble in a place where they said, okay, we either have to increase rates significantly or we have to start non-renew. And the insurance department in California has pretty good restrictions on increasing rate and what would be approved. And so as a result of that, for example, State Farm had to start pulling out of the state of California. And then, of course, the Palisades fire hit, and they got really bad press about it because people were saying, well, there's a wildfire coming and now I'm getting non-renewed. And all of that was well underway before that happened. And so it had nothing to do with State Farm saying, well, we don't want to, cover these risks. It was because they had finally realized that they were overconcentrated, and that was the only response that they could take. So, but on the same front, we look at some of the things that they've done in Florida. They did a bunch of tort reform, and that has significantly improved their insurance market. There have been new carriers entering because now there's more restrictions on attorneys getting involved if there is a loss. And it's allowed the insurance companies to say, actually, now that we're not paying out as much on legal fees, we can decrease our rate. We saw, a 9.5+% rate decrease by one of our carriers earlier this year, which has never happened in the 17 years I've been doing this. And we've seen new carriers enter and new underwriting models. So there is so much that relies on the state regulation, and it's so different across the country that, what's coming down the pike, what we need to respond to, and then how we help our clients do that.
Yeah, there's a tail with all that, right? If all of a sudden you realize you don't want to be in a particular market, it doesn't happen right away, whatever the mitigating force would be, whether it's increasing rates or getting out of the market, right?
Correct.
It takes a while to realize what you get yourself into.
Exactly. I mean, to your point, any non-renewal that's coming out of any state and any insurance company, it has to, one, get approved by the state. Then we have to go through with notifying the clients, and each state, again, has requirements about, okay, that 180 days before renewal, is 60 days before renewal. All of those have to get mailed out. They get to the client, and then the client has to respond. So, there's a lot of work that goes on behind the scenes with the insurance carriers. And then, of course, that's when we start getting the calls. My insurance company is canceling me. What am I supposed to do? And once that starts happening, then the other insurance companies, it's all a spiral. Insurance companies start to pump their brakes, and they start to ask, why is this being remarketed? Is it being non-renewed by another carrier? And so, it's all about then how we present that particular risk to market to make sure that we can find a good solution. But it is, to your point, it's a long tail. And what happened with State Farm is even longer than what we traditionally see, because the state then required that renewals be sent out in those zip codes that were impacted, which again, the consumer. There's nothing inherently bad about that, but it then puts those clients 2 years down the road in a bad situation. And it gives other insurance carriers opportunities to respond and start thinking, okay, well, how are we going to not place coverage for those clients right now? Because there's too many of them that are looking for coverage. So it's a long process.
Yeah, quite a challenge. Is there, switching to how it benefits you as a business, are there things that have evolved nicely in your view to assess a client's needs? At one time, I think it was, you just have to take all the data and look at it, forget about the underwriting, just what's the appropriate coverage. Are there tools that you've been able to use efficiently that allow you to say, you don't need this, but you need that? Has technology been helpful in that way from a business development perspective?
I think to some extent, what I really am enjoying about technology right now is it's allowing our clients and consumers in general to be better educated when they come to us, right? So where historically someone would come to us and they're like, I'm buying a new house. What should I tell you? What do you need to know? I think now they're in this place where they kind of understand what happens, right? Because we can connect with, whether it be one-on-one or just through ChatGPT or Claude or whatever, we can connect with people in that area and hear some of their experiences if they put it on social media or if it ended up in some type of, journal or something like that. So clients will come to us and they'll say, hey, I'm buying a home in the Keys. And they know immediately, I know it's going to be hard to insure. So that definitely helps us, right? Because it's going to be challenging. And it helps us then set expectations pretty quickly versus having to start with that initial conversation of, yes, this is a beautiful house. You're going to love it there. But, we have a mortgage on the
Right.
property. And so this is how we're going to have to interact with the insurance discussion. On the other side, it gives that same scenario, but there's no mortgage. It gives us the opportunity to say, for them to come to us and say, well, I already know I want to self-insure wind. And we don't necessarily stop there with the conversation. We say, that's great. Let us get you a quote so you know what wind insurance looks like. And then let's get you a quote without wind insurance. And then to take it one step further, this home is likely to survive, Cat 1, Cat 2 storm. Obviously, those larger storms, it might be a coin toss, but what's going to get you is the storm surge. It's the water coming through. And so let's talk about flood insurance versus that wind insurance. And so all of those conversations, I think, are really impactful with our clients. And because they're coming to us educated, it's extremely helpful.
Is the flood insurance still subsidized?
Yes. It's interesting because, the National Flood Insurance Program over the last 10 years or so, anytime there's a government shutdown, that program shuts down. And so what that means for existing clients is if we hit a place where their renewal is during that shutdown, they can't renew those policies. And we've seen this. And so that's really challenging. So that program still exists. The other thing that's challenging about that program in particular is it was started in the 80s. And in the 80s, they decided that the max dwelling coverage on a home should be $250,000 and the max contents should be $100,000. And we have very few
A little
clients
dated, right?
Exactly, that's what they need. It hasn't kept up with the inflation factor. And then for our very high net worth clients, it's so minimal that it's almost like, why do we do that? So what we've been doing, and this is again another shift, a lot of insurance carriers, underwriters, reinsurance companies have seen this opportunity and said, the mapping that the NFIP was using is so outdated. Let's start to use technology. And so they've been using AI as it relates to storms that have come through, what they've seen, losses, all of that, and they're mapping it a little bit differently. And candidly, the NFIP is no longer using their flood zoning that they have previously. It still exists. The mortgage companies still use it, which is wild. But the NFIP has also started using a little bit more of a sophisticated system. But these private insurance companies, they can insure in places where the NFIP might be outrageously expensive. They can also offer coverages that are higher than that. And what I like most about them is that they're going to respond to claims better. At the end of the day, you're not relying on FEMA to show up at your door and say, yeah, this is a flood claim. You're relying on a private, adjuster to show up and say, okay, yeah, this is covered. And let's just, work with the insurance company directly. So I think that helps tremendously. But we're seeing a lot of our, traditional home insurance carriers still requiring that flood insurance be in place based upon some of the old mapping as well, which also presents a little bit of a different issue.
Has cybersecurity, is that still something people are cognizant and insure?
Yeah, you've hit my favorite topic. So this is such an emerging risk right now. I think what what we're seeing in our space is that, the commercial cyber policies have been in existence for so long. And even though they have a longer history than personal cyber insurance policies, it's evolving so quickly, and the cyber criminals are learning, they're using AI, all of this, that the policies are still slow to keep up, even though they've been around longer. The personal insurance cyber world, there's there's a bunch of distinctions that we need to make here. So first of all, it started around 2017. So it's still barely 10 years old at this point. And so I think a lot of the companies that are offering it today, it still looks like an identity theft policy. So my identity was
Right.
stolen,
Yeah.
someone opened accounts, and now I need to go to court and prove that I didn't open those accounts so my credit score can come back down. That is not at all what cyber insurance should be. Cyber insurance is truly a situation where a ransomware thing pops up on your computer screen and it says, we've encrypted your data and you need to pay us whatever they choose, whatever the number is, right? It could be small, could be big. Typically, the cyber criminals are going to start small because they know you're going to pay it, and then they'll attack you again with a larger number. And they only have to get it done once. And you don't want to be that one person. And so what I always tell people is you find the right cyber policy. A lot of homeowners insurance carriers are offering it because you want that response plan. You want to know who to call when something like that happens. Or the scenario where you're buying a golf cart and the dealership sends you over wiring instructions. You're fully expecting them because you've said, yes, I want this golf cart. I want it delivered this day. You send the funds and then you show up that day and your golf cart's not there. Well, what's going on? You call the dealership. They said, well, you never executed the wire transfer. Come to find out, someone had intercepted those wiring instructions, changed them, and now your funds are gone. So how are you going to recover those funds? And how are you going to make sure that there's no cyber criminals that are still watching your system or watching your transactions? All of those things are what we need these policies to respond to. And again, you want to know who to call. So if you don't have a cybersecurity team on staff, which certainly some of our clients do, but many of our clients don't, your response, you have someone to call, you say, hey, this just showed up on my computer, and we can direct you right to the cybersecurity firm that the insurance company has already vetted for you. It's almost like putting them on retainer and just holding them until you need them. Because at this point, I think it's more of not if, it's when it's going to happen. And certainly anyone who's listening to this episode that's a business owner of any sort, I am almost certain someone has tried to spoof your email multiple times for your employees or whatnot. We've all seen it, and some of them are very bad and some of them are getting a lot better.
So for example, if somebody wants to buy that policy, so I have a couple questions. One, is it often automatically included in some other coverage? And if not, if you buy it separately, are there things that the insurance companies request or require you to do to kind of thwart the threat that you might have otherwise done, but they insist that you do it? I mean, for the benefit of the audience, like all the stuff you can buy to sort of keep those things from happening are relatively cheap, right? Aside from behavior issues.
Exactly. But that's what the cyber criminals are relying on, is those behavior issues, right? Where you just aren't fully comprehending and you end up clicking the link and you knew you shouldn't have, but you were moving too fast. But to your question, so a lot of times they're added as an endorsement to a homeowner's policy. So it can be bought with your homeowner's policy. What I always tell people to do, though, again, you've got to know what it covers and you got to know what it doesn't cover, because a lot of these cyber policies, like I said earlier, are fronting as identity theft policies. And so the things that I tell clients, these are the claims that are happening. It's the social engineering. And my favorite insurance term is voluntary parting of funds. Are those funds that you transferred to the wrong party because the wiring instructions were changed, are those covered? Because technically you made that decision to send them there and you could have double checked with the dealership. So making sure that those voluntary parting of funds is covered. So social engineering is a big one. Phishing, which kind of ties into that because there's a lot of overlap in that. And phishing being, there was, and there still is, all these text messages coming out saying your toll pass is deficient of funds, update that, right? You go in there, you send them your credentials for the toll road and you include your bank account. So that phishing, we want to make sure that that's included, and ransomware. Those are the three main ones that we're seeing right now. And so if those aren't covered on the endorsement to your homeowner's policies, there are standalone options. They're about the same price. And we haven't even talked about price, but as it stands today, it's about $150, $200 a year for $25,000 to $50,000 of coverage. It's extremely inexpensive, which again is another reason that we're telling clients it just makes sense to have it. And so buying one of those standalone policies makes a lot of sense for clients. And then if we think about, okay, so what does the underwriting process look like, right? When you buy a home, there's all these questions about the property. When you buy a car, who's driving it? None of those questions right now exist in this space. So it's essentially like, you want a cyber policy? Okay, great. What level do you want it at? Click an issue at this point. I imagine that will change at some point, and you get to higher levels of coverage. And certainly there's a little bit more underwriting. Some of our carriers will offer $1 million or $2 million of coverage. And then they start to ask some questions about, have you had any losses? What does your network security look like? Things like that. But, it's very, very minimal. And so, right now is a great time to get in and start to consider that it's out there. And then, from a perspective of just making sure that you're secure, the easiest thing that I tell people you need to do is, if you have an internet router in your house and you've used the default password, that should be step number one, is updating that. That default password typically is on the bottom of it, right? Simply changing that can create, another level of complexity for these cyber criminals to come in and try and get into your system. There's certainly a lot of ways that we encourage our clients to be proactive and to make sure that you have the right risk management techniques in place. But right now, not very many of the insurance carriers are requiring anything like that.
You don't want the insurance companies to lose money to the point where you can't buy the policy anymore, but I get your point. You might as well buy it because it's just a rounding error now.
Mm-hmm.
And what's the solution? For example, if somebody comes in and hijacks your computer, the $25,000 isn't going to necessarily do much good to recover all your data, right?
Correct. Yeah. So I think, at that point, and again, it's the response plan, right? Because I don't even know who to call. So maybe that 25,000 isn't enough, but at least they got started. And now I know the vendor to use. So if that claim continues on and they have to spend more time just making sure that everything's put back together the way that it should be, then I'm going to pay that vendor out of pocket until I get them back. I think one of the distinctions that we also haven't really spoken about, and this really presents itself when there's a business owner involved or there is a single family office set in place, is the distinction between the business cyber policy and the personal cyber policy. So a business cyber policy is going to cover, as it sounds, anything that relates to the business. But the second that you start using that Hotmail account, or the second that you pull out a personal cell phone and you start using that, that's where they're going to say no, because they've underwritten the business as if you're using, the business email address, the business networks, the business property. And now I've got my personal cell phone involved. And so where it comes in with family offices is, you think about, okay, so we have this operating entity. We have this executive director. We've got some staff on there. They're all covered through the business. But what happens with the principals? Because they're interacting with these individuals every day, and they're the ones with the name. And so how do we make sure that the business policy extends to them, right? Do we set them up on a business phone, right, that ties to the family office, a computer, a tablet, whatever it might be? We make sure that they've got a Smith family office email address, whatever it might be. But then we also make sure that they've got their own cyber policy, because they live in these homes, and these homes have all these smart devices, which again are just more entrants for the bad actors. So that gray area between a business and a personal policy exists, particularly in the family office space. So the way that I always go about it is, let's not leave it as gray. Let's just overlap as much as we can, right? And let the insurance companies at that point argue about who's going to pay what claim and what policy it should be put on, and know that it's covered and we've got a response that's going to happen immediately.
It's super helpful, Amanda, because we go about our day not thinking much about the insurance, right? I mean, let's just face it. It's you buy the policy, you hope that you're covered, and then you do whatever you're going to do. And there is a certain level of being conscious about the hackers and what's happened because you hear enough of it, but you still go about your business. You still use your personal phone. You still use a Gmail account. You still do all that stuff, right? So it would be, especially if it's not very expensive, comforting to know that the business and the personal is covered. I think that's really important advice. Mm-hmm. And what are people really, aside from you bringing it to their attention, are people surprised when they hear they've got to be this diligent about it?
I think there's just a lot of assumptions, right? A lot of assumptions that, again, it's covered. And so like when we're talking about anything in the property and casualty space, it's important for us to remember that these are all contracts, right? And so if there's any gaps or holes in the contracts for the consumer, well, then we're in trouble. The insurance company's got the best attorneys behind them. And so they know that there's not very many holes. They feel confident in that. And so my job is to sit here and say to the client, have you thought about this? I'm going to go back to a golf cart scenario, right? I had a new client come to me and say, here's all my insurance policies. And they've got a home in a place where people have, I'll call them toys, right? It might be a golf cart. It might be an ATV. It might be a boat. There was none of that involved with what he had sent me. And I said, you probably have one of these things. And he's like, you're right, I do. It's a golf cart. It's like $70 a year. It's not a problem. That's what makes me the most nervous is, right? He's going about his day thinking like, it's just a golf cart. It's fine. It's August. I've seen multiple deaths this year on golf carts with our clients, whether they were involved in an accident with a golf cart or they were driving. And those are the things that worry me the most, is the ones that the client's like, not a problem. My 18-year-old drives that golf cart all the time. Well, I now always just see them flipping, So for that particular client, it was an immediate increase this. I don't care if you place your coverage with us, increase your liability coverage immediately and make sure it's added onto the umbrella policy so that you've got that protection in place. And to your point, so many people, we don't think about insurance every day. And if I wasn't in this business, I absolutely wouldn't either. But there's so much risk out there. And, thinking about the family office space, the family office entities, if they're managing investments, they're sitting there and they're thinking about investment risk, right? And to some extent, that can be predictable, right? We can, within reason, say that we can lose or gain this much. What we don't know is how much that claim is when your 16-year-old rear ends a bus. What we don't know is how much that claim is when the bad actor gets into your system and starts draining accounts. We don't know those, and they can happen fast. And so my goal is to not sit here and scare people and tell them, okay, well, these are all the risks you need to be thinking about 24/7. But my goal is to say, don't have the blinders on, right? We have to remember that there's more outside of just that investment that you're trying to make a decision on. And there's risk associated with that as well. Dive into the family office commercial piece of things, because single family offices aren't as regulated as like an RIA might be. They're not required to carry any type of professional liability or errors and omissions coverage. They're not required to carry any directors and officers coverage. And there's so many nuances within those coverages that are important. But, we're hiring this staff and we're trusting them to make the right investment decisions. And we might have a little bit of oversight over that as well. But what if they don't? What if they make the wrong decision and we told them not to? How are we going to respond to that to continue the legacy that the family office was set up to do in the first place?
I think that it just is just my viewpoint, but I think what you sell is peace of mind. In other words, if you take the time, assess the risk, do the work of addressing those risks and ensuring them, then you can go about your business not worrying about that, right?
Absolutely. I mean, on the small side, people ask us all the time, what umbrella policy, what limit should I have, right? And we can't answer that question for them because some clients are so nervous about getting sued, whether it be because they have pools or teenage drivers or boats or whatever it is, that, insuring up to their net worth couldn't be enough for them, right? And to the same extent, we've got clients who are like, you know what? I'm retired. I have 2 cars. We own one property. There's no pools involved. Kids are out of the house. We're good. And simple 10 million, $15 million limit is perfectly fine for them. And that helps them sleep at night. And so again, that's the conversation we have is like, what's the peace of mind for you? To your point, what's going to help you sleep at night? And you could look identical to your neighbor. Doesn't mean you guys choose the same limit, right? It's really a one-off. And so us being able to kind of guide people through this is the coverage that's available to you. This is how much it costs. All of those type of things, I think really helps us help our clients make a good decision, be involved in that decision-making process. It should never just be us saying, hey, here you go. This is what you get. It should always be kind of a partnership.
Totally makes sense. Well, this has been super helpful. Would you just tell everybody how to get a hold of you if you're interested in having any of the people perhaps that are listening today pique their interest with some of the stuff that we've talked about? That would be awesome.
Yeah, absolutely. So you can visit our website. It's bcurisk.com. That's B as in boy, C as in cat, universityrisk.com. You can shoot me an email. My email is Martinez@bcurisk.com, or you can find me on LinkedIn.
Awesome. Thank you for doing this, Amanda.
Of course. Thanks for having me.
So you're welcome. We'll let a couple months go by. We'll come back and revisit and see what new risks AI has presented us that we can potentially insure, right?
Yes, definitely.
That would be good. Okay. Thanks everybody for joining us today. Amanda, stick around for a minute.